Hi, welcome back to the channel. Hope everybody's doing well out there. We certainly can't control what direction the market moves, but we can always look for stocks to buy right now or add to our watch lists, and that's exactly what I've got here. 3 UK based stocks which, although things are crumbling around us, can still offer something good within the market. If you enjoy this video, please drop it a like and subscribe to the channel if you get some value out of it. Stock number 1 is B&M European Value, which is a Luxembourg-based holding company of the group. The principal activity of the group is variety retailing in UK and France. The company's stores are in and out of town centres, retail parks and local shopping parades and precincts. They mainly source products direct from the manufacturer, and in the UK have around 650 B&M stores. The Heron Foods chain has around 290 convenience stores, and in the French retail market, Babou operates around 100 stores with general merchandise, clothing and footwear. Over the last 5 years, B&M has been a really strong performer within the market, being up 45% in the last 5 years. It's had 2 substantial sell-offs, taking the share price under £3 only once in 2019 and then during the COVID sell-off. Both times though, the share price has recovered and recently it's been trading at all-time highs. As with most stocks this year, it's had a bit of a pullback, sitting down 11% from 1 year ago and down even more from its highs of close to £6.50 per share. With a PE of under 12, it looks good value at the moment. This company does pay a dividend, which we'll go into in a bit more detail soon. Just recently, the billionaire B&M boss announced that he is to retire from the discount chain after 18 years, which this could be an additional factor into why the stock has been selling off. Simon, alongside his brother Bobby, acquired the business from Fildrew Investments in late 2004 when it was an ailing regional chain of 21 stores and built it into a retail empire of 1,100 shops in the UK and France. It's listed on the FTSE 100 with a market cap of more than 5 billion, and that was at the time this article was written. There's no doubt that this pair of brothers have done an incredible job in building such a successful business. When you see the financial growth over the last few years, it certainly justifies its valuation. I would even argue that it should be valued more. 2021, they recorded their best year by a country mile, and this was mainly due to the fact of the COVID lockdowns. During this time, B&M were able to stay open as an essential business and flourish considering the circumstances. With 2021 being such a standout year, it does provide tougher year-over-year comparables, but with consumers finding their wallet tighter this year, I think that the discount store could see an influx of new customers. Running through the balance sheet, we can see that last year they had 217 million at the bank, down from 428 million the year prior, with assets sitting around 3.4 billion, and B&M report results at the end of May, so unfortunately for now we can only use the information currently available. Total liabilities was up 1.3 billion in 2018 to 2.6 billion last year. Net assets of 732 million, the lowest it's been in the last 3 years. We can still certainly have a look through the 2021 accounts to get a gauge of the business and the likelihood of future success. The group continues to generate strong cash from operations, and on the back of last year's results rewarded shareholders by paying out 697 million in the form of dividends, which also included a special dividend of 150 million. They also mentioned that the net debt did increase, but still super manageable on the basis that net debt to adjusted EBITDA leverage was less than 1 times. One of the perks of owning B&M is how generous they are with their dividends payout. With growing payments over the last few years, this company has really made some income-focused investors really happy. We can't guarantee any future payments, but we can make a guess that in the long run, you'll still get something back put into your pockets in the form of dividends. In January, B&M issued their Q3 trading update relating to the 13-week period from the 26th of September to the 25th of December. Group revenue growth was basically flat on a constant currency basis. Total B&M UK was down 2.5% year over year, with 1 year like-for-like down 6.2%, but up 14% on a 2-year basis. Strong performance across categories, with excellent sell-through of seasonal ranges supporting gross margin in the quarter. They opened 9 new stores for B&M UK with 2 closures, and they expect another 13 to open before the full year end of 2022. Performance in Heron Foods continues to improve with 2-year like-for-like revenue growth in Q3 2022. Sustained momentum in B&M France with Q3 revenues up 30% year on year in all but one of the 107 stores now under the B&M branding. They will reward over 24,000 colleagues for their considerable efforts this year with a discretionary bonus payment of an extra week's wages in January, and what a perfect time to get a bonus right after Christmas. Full year 2022 group adjusted EBITDA is now expected to be in the range of 605 to 625 million, which is ahead of analyst expectations, which had the consensus of 578 million. This extract taken from Investopedia goes through what type of companies perform well in a downturn. Consumer staples being heavily noted due to their day-to-day requirements, but discount stores often do well during recessions as their staple products are often cheaper, which is why I think that we could be looking at a good company to own over the next year or so. Tip ranks have an average price target of £6.13, which would equate to nearly 25% upside from current levels. 8 analysts have varying ratings on B&M, with 2 rating at a buy, 5 hold and 1 sell. Stock number 2 is Target Healthcare, who operate as a UK healthcare REIT. Their objective is, as it says on the tin, the group has a straightforward investment strategy to provide stable and sustainable dividend income to investors from a carefully selected portfolio of modern care homes, diversified by tenant, geography and end user payment profile. Over the last 5 years, the share price has had some peaks and troughs, but we're talking about relatively low volatility on a percentage basis. This company won't make you rich overnight, but can provide ample income from its over 6% dividend yield. On a 1 year basis, it's down 5%, which when you compare this to other areas of the market, a measly 5% drop is nothing, especially when you're getting paid 6% on a yearly basis. The main reason you would want to purchase a company like this would fall down to 2 main reasons. One being that it's less volatile than most other stocks through good and bad times, and secondly, it generates big juicy dividends which have been slowly growing over the last few years, appealing to income focused investors. Target Healthcare have been growing revenue and earnings consistently since 2018 and performed extremely well during COVID, really showing you how resilient this company and business can be. Taking a look under the hood, we can scan through their balance sheet to see last year what they were sitting on, and they had 21 million in cash at the bank, with total assets equating to 718 million, which is more than double which they had 5 years ago. Total liabilities has been growing from 49 million up to 153 million, which is to be expected, but these liabilities or debt are usually fixed against brick and mortar assets, and this can be seen in their net asset health, which was 256 million in 2017 to 565 million in 2021. Some of the highlights that's noted is the significant portfolio growth that mainly came from an acquisition of an 18-home portfolio, which contributes stable assets with a mature trading history. Enhanced stability from new long-term capital with 100 million additional long-term debt at attractive fixed interest rates, following a £125 million equity issuance. Resilient portfolio performance with robust rental collection and like-for-like valuation growth. The portfolio growth of 186 million by market value was mainly contributed by the £171 million acquisition that they carried out. Wet rooms are available 96% of the portfolio, which is relative to the national average of 29%, with tenants up 11% to 31%. They reported low to mid-single digit growth across various metrics, with rent collection remaining high at 96%, and of course the company aims to provide regular dividends for shareholders, with their focus being on disciplined and conservative financial and risk management to deliver earnings supporting these quarterly dividends. Up to the 6 months period ending the 31st of December last year, the company's results showed steady revenue and income growth, with total income of 27.3 million, up from 25 million in 2020. Expenditure up slightly from 5.9 million to 6.1 million, and finally showing total comprehensive income for the period of 19.38 million, up from 15.9 million. Tip ranks have this with a price target of £1.21, giving a potential 7% gain. There's 2 analysts on this one, both giving it a current hold rating. And last but by no means least, we have SCHRODERS PLC, who are a UK-based asset management company. The company operates through 3 business segments: asset management, wealth management and the group segment. The asset management segment principally comprises investment management, including advisory services in respect of equity, fixed income, multi-asset solutions and private assets and alternative products. The wealth management segment principally comprises investment management, wealth planning and banking services. The group segment principally comprises the company's investment capital and treasury management activities, corporate development and strategy activities and management costs associated with governments and corporate management. The 5-year chart shows some volatility, but anywhere around these current levels has been a decent buying opportunity in years gone by. It is down 11% over the period, but offers fair value at a PE ratio of under 13 with a dividend yield of over 4%. Schroders topped out around August-September time last year and has been in a visibly downward trend, down nearly 20% on a 1 year period. It has had a decent sell-off, which is one of the reasons why I like this company. Schroders has had a significant turnaround in the earnings, from decreasing earnings in 2019 and 2020 to topping out at over 3 billion in 2021, with the best earnings in over 4 year period shown. The balance sheet shows a wad of cash of 5.1 billion, the highest in the last 5 years, with total assets following the same trend sitting at 24.3 billion. Total liabilities are the same as they were around 2017, sitting at around 19 or 20 billion, but it has been increasing since 2018, but nothing to worry about with the net asset trend which has been going in the correct direction from 3.4 billion up to 4.4 billion. Schroders' latest results showed a new high for assets under management in its full year results, which reported an 18% improvement in net income to 2.57 billion, while its profit before tax and exceptional items was 19% higher at 836.2 million. The FTSE 100 asset manager said its operating expenses were 17% higher year on year for 2021 at 1.73 billion. Earnings per share of £2.20, up 18%, and a nice 7% hike in the total dividend, bringing it to £1.22 for the year. Schroders said its 3-year investment performance was strong as 79% of assets outperformed the relevant comparator. The company generated net new business of 35.3 billion, representing an annual organic growth rate of 5%. Assets under management increased 10% to 731.6 billion compared to 663 billion at the end of 2020. They finished by saying that strong financial performance reflected the investments it had made in recent years. And all that information I've rhymed off can be seen in their earnings presentation, showing the respective increases across the board. Schroders' assets under management has been growing at a 5-year combined annual growth rate at 10%, from 453 billion back in 2016 to the 731 billion mentioned earlier. Their diversification can be seen starting from their largest investments, with mutual funds at 32%, institutional at 27%, private assets and alternatives at 16%, wealth management at 14%, and solutions at 11%. The performance across all 6 divisions have grown, with solutions making up most and also growing the most at the joint highest percentage of 120%. They're also a leader in the transition to a sustainable world, with some really notable mentions, specifically the 5.7 billion in Article 8 and 9 net new business in 2021. When you see this Article 8 or 9 term, this is the official name given to the ESG, environmental, social and governance investments. The total amount of assets under management in this category stands at 60.5 billion. And just to follow on and finish up on this stocks overview here, this is another snapshot highlighting the key performance notes across the various aspects of their business, all sporting a really positive trend within the company. 8 analysts on here with an average price target of £35, giving 24% upside from current levels. 1 buy rating and 7 hold with 0 sells. This will bring us on nicely to the end of this month's UK picks. I hope you've enjoyed the overview and I'll catch you all in the next video. Cheers guys.